Just wanted to give you your quick monthly market update for here in Connecticut. Just going to dive right in. So when you look over here, um, first thing I wanted to talk to you guys about is price reductions. What's really interesting, we saw this starting to trend up for a period here towards the end of 2022. Um, Reaching as high as 40% of the listings on the market experiencing a price reduction. Um, that's huge compared to what we were experiencing during the pandemic, where it was just like everything that hit the market, you can name your own price, and everything was just flying off the shelf, right? Then, as you can see over here, as you got into the year, going into 2023, that started to decline. What's normal is this, somewhere between 30 and 33%, you'd be seeing price reductions on the market. So we're returning to those levels, showing that the market's starting to really strengthen, which is really interesting since all the news that you've been getting is so negative. And I think that this is a real cause of it. When you make the comparison of between pending home sales, which is your measurement of demand, and then your actual mortgage rates. So the number of houses coming off of the market is a really great measurement to show you, all right, how active are buyers in this marketplace. And then, as you can see, as interest rates started to spike up over here, you see that demand was really falling down right when we were reaching around 7%. Then as mortgage rates start to come down again, right, you start to see demand returning. Um, so again, further evidence of a strengthening market. This is just further supporting that with the pending contracts. We're up 6% week over week. Just further showing you see this long trend going down and then all of a sudden this pop up. And I think that really has to do with these interest rates and how those correlate between the two. Not to nerd out, but I was talking to a financial advisor, and when you're thinking about mortgage rates and trying to figure out where they're going, you really want to look at your long-term bond market. So like your 30-year treasury bond. And the reason is if you're an investor and you're looking to invest in either mortgages or you're looking to do a long-term investment, you'd be looking at either mortgages or treasuries. Well, mortgages aren't really guaranteed and there's a little bit of risk because the person could foreclose, right? But if you're looking at treasuries, right, it's guaranteed money. I mean, unless you think that the United States is going to fall apart and they're going to default on their debts. Which we'd have a much bigger problem if that happened, right? Collapse the dollar, so on and so forth. Um, so in order for mortgages to compete, they have to offer a higher interest rate than what the treasury bond market is. So if treasury bonds are going down, then mortgage rates would go down. And they have been dropping consecutively for some time now, showing a much more longer term trend that the stock market, bond market really is thinking that that inflation is transitory and it's not going to really stick around for the long term, which is now driving down those interest rates. So I'm, looking into my crystal ball and what I think is going to happen is I think that interest rates are only going to continue to trend down for mortgages, because what the Fed is doing with their benchmark rates is a whole different thing. They're correlated and related, but they're not the same thing. When you hear rates are being, Fed's doing another 25% rate hike, it's not the same thing. So let's talk about what's going on here locally. It's just that continued trend line, right? So this is New Haven County and this is Hartford County. It's median sales price, just continuing to drive down those prices. It hasn't shown up here yet with the return of uh, with that strengthening that you saw on the national level. It is locally to some marketplaces, like if you look at individual towns, but it's definitely not as for the overall market of Connecticut. Um, so what does this all mean to you? Well, what it means to you is that the real estate market is really, really strong, that it's looking like price increases are going to be starting to return at least in the short term, maybe not the long term. That's really dependent on how well the Fed is able to pull back inflation without beating up the job market too bad. So if the Fed pushes us into the recession and beats up the job market, well, what that's going to do is uh, significantly decrease demand because people don't have jobs, right? So they've really got to get that balance right, and it's a real tricky thing. Particularly, we're in a global market, and there's so many things and factors that are affecting these that are affecting inflation. I hope you found this video helpful. My breakdown on what I think's going on in this crazy times that we live in. Really exciting times because I mean we're really watching history in the making. Um, we've certainly never seen anything like this happening in the past. There's definitely been similarities, but nothing like this before. Um, so yes, so stay tuned, and I'll see you next month.